Now, it's never, and I mean never, a fun day when one of your holdings in your long-term portfolio miss on earnings substantially and lose around 12% of their value in a single trading day. Not to mention when one of your holdings that you've been holding on to for years now, and at one point you were up significantly on, is now down over 32% in the 1 year time frame. Now, the stock I'm talking about, you guessed it, is none other than United Parcel Service, or UPS, which has had a rough year to say the least. And like I said, UPS is in my long-term portfolio and has been for quite some time now. Now, in this video, we're going to dig into exactly why UPS has dipped like crazy as of recently and figure out if or if not this dividend growth stock that is trading right near its 52-week range low is offering a potential long-term buying opportunity. So if you want to dig into UPS with me, see what this one has to offer, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, like we all saw, UPS dropped like crazy, and this is due to things like cheap deliveries swamping UPS earnings and sending the shares reeling down. It says UPS lowered its 2024 operating target, this was on Tuesday, after new e-commerce customers identified by industry experts and shoppers as Shein and Temu flooded its network with slower and lower profit shipments. Shares of the world's largest package delivery firm tumbled 13%, and this is after it missed Wall Street estimates for a second quarter profit. UPS declined to name the new customers, but its description of them as shoppers with explosive volume matches the profiles of things like Shein and PPD Holdings, Temu, which sends inexpensive clothing and other goods from Chinese factories direct to US shoppers via the lowest cost delivery option. So it looks like Shein and Temu, who would have guessed it, are sort of at fault for UPS's profit. It says Shein and Temu together send almost 600,000 packages to the United States every single day, according to June 2023 report by the US Congress. That volume has already roiled the air cargo business and appears to be doing the same to the last mile delivery industry. During the quarter, volume from the new unnamed UPS customer blew up upon us. Their demand was much higher than we had anticipated, CEO Carl Tome said in a conference call with analysts. That drove a shift from premium air services to less expensive ground services, and from ground to even more economical SurePost services, where UPS picks up packages and hands about 60% of them off to United Postal Service for final delivery, she said. FedEx executives previously noted a similar trend among its customers. Now, along with it, it says e-commerce giant Amazon is already the biggest customer for UPS. The addition of more low-margin e-commerce businesses come as UPS also prepared to replace FedEx as the primary expedited air service provider for the USPS in October. Now, Tome in an interview said UPS remains laser-focused on adding higher margin volume, including business-to-business and temperature-controlled healthcare shipments. The Atlanta-based company on Tuesday said adjusted profit was $1.79 per share for the quarter, below analyst estimates of $1.99. It also lowered its full-year adjusted operating margin forecast to 9.4%, and this is from a range from around 10 to 10.6. Now, lastly, the company recently slashed about 11,500 jobs to save around $1 billion, but we have shown that we can drive costs out, and we can continue to do that, Tome said. UPS expects cost pressure to ease in the second half of this year. So it looks like partially because of Temu and super low-cost e-commerce items, UPS is not making nearly the revenue or profit they once thought they were. And because of this, UPS is now trading at the same level that I was trading basically all the way back to 2020. Now, I was looking up to buy some shares of UPS, and I've been holding ever since in 2020, and my average cost per share with UPS is around $96 per share. But what's crazy is that it feels like just yesterday that UPS was trading around $200 per share, and the bigger question is, will this recover over the next year? Will this one come back? Well, as far as a potential buying opportunity, UPS, now where it's trading, is offering a 5.11% forward dividend yield, which is insane, considering over the last 5 or so years, the average dividend yield that UPS had was around 3.33%. So for dividend growth investors like myself, it is honestly tempting to lock in some more shares of UPS and get a massive starting yield that also has been growing historically. But another concern, especially because I already own shares of UPS, is definitely dividend safety. And right now, according to Simply Safe Dividends, the dividend safety looks like it's around 69, which is safe. But again, after this most recent earnings, I think we can all agree that UPS's dividend is even less safe than before. Not to mention, although UPS has had some massive dividend growth historically, UPS's dividend growth rate is around 10% over the last 20 years, 12% over the last 5, but as of the latest, 0.6%. And this is due to just back in March, UPS had another dividend raise coming up as far as the previous cadence goes, and UPS raised their dividend a measly 1 penny. Now, I'm not going to lie, this made me pretty upset. I was expecting a 10-cent raise across my portfolio or something of the sorts, maybe not a 50-cent raise like we saw back in 2021, but a 1 penny raise is pretty disappointing. Now, of course, as a shareholder with a company that seems to be in some trouble, I'm not saying they need to raise their dividend whatsoever, but again, just based off the previous raises, it sort of changes the outlook for UPS for a dividend growth investor standpoint. Now, if we were to type in UPS in my custom Benjamin Graham formula valuation tool, it does show that UPS right now with a share price of $127 per share, offering a 25% margin of safety and a 12.5% growth rate. Even with all that said, UPS's fair value is around $119 per share or an $89.52 price target, at least as far as the formula is showing. Now, for me personally, I'm going to sit back and not purchase any more UPS shares as of right now. Although I will say if it gets close to my cost basis at around $90 per share or so, I'll probably load up on some shares because at that point, it's probably just too cheap to pass up. But now lastly, most importantly, I want to hear from you guys down below when it comes to UPS and this recent slide, even the fact that UPS has been sliding basically ever since February of 2022. Are you guys personally loading up on UPS as of right now? Let us know in the comments why or why not. If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.